Well, good to be with you, folks. I'm sitting here in my office in Omaha, Nebraska, just like I have for more years than I care to count, looking out at the city I've always called home. My dad, he ran a stock brokerage right here during the Depression, and I remember watching him. He taught me a lot, not just about numbers, but about character and integrity, which it turns out are far more important in this business than most folks think. I've been doing this for 80 years now, if you count my paper route days, and I've learned a few things, mostly the hard way and mostly by making mistakes. One of the biggest mistakes, real bonehead move, still sticks with me plain as day. It was back in 1993, and Charlie and I were looking at a shoe company called Dexter Shoe. Now, Dexter was a New England institution, made good quality shoes right here in the US. We paid for it with Berkshire Hathaway stock, which in hindsight was the equivalent of taking $100 bills, setting them on fire, and then feeling good about the warmth. We gave up 1.6% of Berkshire Hathaway, which at the time was worth about $433 million. Sounds like a lot, doesn't it? Well, today, that same 1.6% of Berkshire stock would be worth something in the neighborhood of over $15 billion. $15 billion. What a fool I was. I was so excited about getting into the shoe business, and I convinced myself that Dexter had a durable competitive advantage. I remember the feeling of optimism at the time, thinking we were getting a solid American business. The problem was, I was dead wrong. Dexter didn't have a moat, not a real one. Anyway, it turned out to be a business where the product could be replicated cheaper overseas, and there was nothing proprietary about their process or their brand that truly protected them from competition. The company went downhill fast after we bought it. We ended up closing the factories in Maine and liquidating the business. That $433 million mistake paid in Berkshire stock grew into an astronomical opportunity cost, a constant reminder of how important it is to truly understand the competitive landscape of a business. I remember the sleepless nights thinking about all the other things we could have done with that capital, or more accurately, with that piece of Berkshire. Charlie, he just shakes his head when I bring it up. He's probably thinking, Warren, how many times do I have to tell you about the importance of a moat? Here's what I learned from that mistake, and it's a lesson Ben Graham taught me, though I sometimes forgot it in my youthful enthusiasm, or as in Dexter's case, my older enthusiasm. Investing is not about finding the fanciest, most high-tech company or the one everyone else is buzzing about. It's about finding a wonderful business at a fair price. And what makes a business wonderful? A durable, competitive advantage, a moat. Just like a medieval castle had a moat to keep invaders out, a business needs a moat to protect its profits from competitors. Dexter didn't have one, or if it did, it was shallow and quickly dried up. Now, look, a moat can come in many forms. It can be a strong brand like Coca-Cola, where people around the world will pay a little more for that specific taste. It can be a cost advantage where you can produce something cheaper than anyone else. It can be network effects, where the more people who use a product, the more viable it becomes. Or it can be something like government regulation that creates a barrier to entry. Whatever it is, you need to understand it cold. When you assume a business is better than it is, you're setting yourself up for disappointment and potentially for a multi-billion-dollar mistake like Dexter. This focus on moats is something Charlie and I talk about constantly. He always says, tell me where I'm going to die so I don't go there. In business, that means understanding the risks and avoiding businesses that lack fundamental protection. I'd rather own a small piece of a truly wonderful business than 100% of a mediocre one. It's really quite simple, folks. You want to own businesses that will be around and thriving decades from now. When I was running my partnership in the 1960s, I sometimes got drawn into what Ben Graham called cigar butt investing, buying deeply distressed companies at bargain prices, hoping for one last puff. It worked, but it was a lot of work, and it wasn't scalable. Charlie pushed me to think differently, to buy high-quality businesses, even if I had to pay a fair price, because the compounding from those superior economics would far outweigh any initial savings on a crummy business. Let me give you a couple of the examples that illustrate this point about moats. Take See's Candies. We bought See's in 1972 for $25 million. It was a well-loved California brand, a regional powerhouse. My partner, Charlie, he convinced me that it had something special. People loved See's. They'd buy it for holidays, for gifts. They'd even stand in line. It had pricing power, meaning we could raise prices a bit each year without losing customers. That's a powerful moat. Over the years, See's has generated billions for Berkshire, far more than the initial investment. It's a simple business, chocolate and nuts, but it's got an incredibly strong brand, a moat built on taste and tradition and trust. That's the kind of business you want to own. Or consider Coca-Cola. We started buying Coca-Cola stock in 1988, paying about $1.5 billion for 7% of the company. It was a fantastic business with a global brand, recognized everywhere, incredible distribution, and a product that people loved and drank repeatedly. It had a network of bottlers that would have been impossible to replicate. We ended up owning much more. Today, that investment is worth many, many times what we paid for it, and it pays us a massive dividend every year. The moat is so wide that practically everyone in the world knows and buys their product. Compare that to Dexter, where the moat evaporated when cheaper shoes from Asia arrived. It's a vivid illustration of the difference a durable competitive advantage makes. Our position in American Express is another one. In the 1960s, after the salad oil scandal, where Amex was defrauded, the stock plummeted. Everyone was panicking, but I saw a strong brand, an essential service, and a business whose reputation would recover because people trusted the name. I remember flying to New York and personally visiting all sorts of places, from restaurants to merchants, to see if they were still accepting American Express travelers' checks and cards. They were. I put 40% of our partnership's net worth into American Express. It was a contrarian move, buying when others were fearful, but it was based on understanding the durable power of their brand and their underlying business. That investment paid off handsomely, all because the moat, in this case, a brand built on trust, held strong even during a crisis. A very young investor today, or frankly, any investor, the most important thing you can do is to understand the businesses you own or are thinking of owning. Don't invest in a business you can't understand. Phil Fisher, another great investor, really emphasized understanding the qualitative aspects of a business, the things that aren't just numbers on a balance sheet. What's the management like? Do they love the business? Are they honest? What's the company culture? These things matter, maybe even more than the numbers in some cases, because they speak to the durability of the enterprise. You don't need to be a genius to understand this. You don't need fancy math or complex algorithms. What you need is a basic understanding of economics and a dose of common sense. Think about businesses like you're going to buy the whole farm. If you were buying a farm, you'd want to know if the soil was good, if the crops would grow, if you had good management, and if it was protected from floods or droughts. You wouldn't buy a farm just because your neighbor bought one or because someone on TV told you to. The same goes for stocks. People think you need some kind of special insight or a crystal ball to make money in the market. That's simply not true. What you need is patience, discipline, and the ability to ignore the noise. The market is there to serve you, not instruct you. It's like Mr. Market, the fellow Ben Graham conjured up, who shows up at your door every day offering to buy or sell his share of a business. Some days he's euphoric and offers a crazy high price. Other days he's depressed and offers a crazy low price. Your job is to ignore his moods and only transact when it makes sense for you, when his offer price is wildly different from your assessment of the business's intrinsic value. This applies to any business, not just investing in public stocks. What really matters in business is finding an operation that serves a real need, does it well, and has some sort of enduring advantage. We look for management that is capable and trustworthy, people who love their business and run it as if they were the sole owners. We like businesses that don't need a lot of capital to grow businesses that generate cash flow year after year, businesses that are simple to understand. Our model at Berkshire, where we let our managers run their businesses largely autonomously, works because we pick good people running good businesses. But that's not the only lesson I learned the hard way. This reminds me of another time when I made a mistake of a different flavor, one that cost us a lot of money simply because I got stubborn and let emotion cloud my judgment. The truth is, sometimes the biggest enemies we face are ourselves. I try to buy businesses so wonderful that an idiot could run them because eventually one will. But even then, my own idiocy can sometimes get in the way. This second lesson came much later in the mid-2010s with a UK grocery chain called Tesco. We had a pretty significant position in Tesco, an investment of around $2.3 billion. For a while, it seemed like a solid, predictable business. But then things started to go south. They had accounting issues, management problems, and their competitive position started to erode. Instead of acting decisively, I dithered. I sold some, but not enough, and held on to a substantial chunk for too long, watching the value decline. Eventually, in 2014, we sold the bulk of our remaining Tesco shares. I lost $44 million on that investment. What a bonehead move. I was too stubborn to admit I was wrong and too slow to exit a deteriorating situation. I kept thinking it'll turn around. It's a big company. They'll fix it. But the signs were there. I just didn't pay enough attention, or rather, I let my initial investment bias keep me from seeing the reality. That's a huge lesson right there. Admitting your mistakes quickly is crucial. Charlie always tells me, when you find yourself in a hole, stop digging. I was still digging. Here's what I learned from that mistake with Tesco, and it ties back to Ben Graham's concept of intrinsic value and margin of safety. When the intrinsic value of a business is clearly deteriorating, you have to act. You can't let your original thesis blind you. The market doesn't care what you paid for something. It only cares about what it's worth now and what it will be worth in the future. My dad taught me to always be honest with myself, and in this case, I wasn't being honest enough about Tesco's future prospects. The numbers were telling me one thing, but my ego was telling me another. The key lesson is to understand when the facts have changed. A company might have a strong moat one day, but that moat can erode. New competitors, technological shifts, poor management decisions. All of these can chip away at what once made a business wonderful. With Tesco, it was a combination of management missteps and a shifting retail landscape. My mistake was clinging to the past, assuming that a large established business was somehow immune to these forces. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But even wonderful companies can stumble. And if they do, you need to be prepared to reevaluate. This is where the discipline comes in. Rule number one, never lose money. Rule number two, never forget rule number one. Now, obviously, you're going to lose money on some investments. Not every pick is a winner. The point of the rule isn't to never have a losing stock, but to think about risk and value so thoroughly that you minimize permanent capital. With Tesco, I failed to honor rule number one because I let a deteriorating situation fester, turning a bad investment into an even worse one through inaction. It was a failure of selling discipline, which is just as important as buying discipline. Contrast this with how we handled other situations. When we got involved with Salomon Brothers during their trading scandal in the early 90s, the intrinsic value of the brand, the company's integrity was at stake. We stepped in to restore trust because we believed in the underlying business and the importance of its role in the financial system. We knew there was value to save and the right leadership could do it. That was a calculated risk to protect the brand. With Tesco, the damage was internal, structural, and ongoing. The lesson is about distinguishing between temporary setbacks for a fundamentally strong business and permanent damage to a declining one. Think about our approach to buying businesses for Berkshire. We're not just buying a set of assets, we're buying a business run by people. We want to own businesses with great management, folks who are honest and competent. We've been very lucky with managers like Ajit Jain, who runs our insurance operations with incredible skill and integrity. He's built an empire within Berkshire, and he always thinks like an owner, or folks like Charlie and I who just love what they do and are good at it. When you have that kind of talent and they're focused on running the fundamentally good business, your odds of success go way up. This brings me to another critical principle, the power of compounding. When I was a young boy delivering newspapers in Omaha, I saved every penny. I bought my first stock, City Service Preferred, when I was 11 years old for $38 a share. My sister Doris bought some too. It dipped to $27 and she let me hear about it. But it came back up to $40 and I sold it, a small profit. Then it quickly went to $200. I learned early that patience pays off and selling too soon can be a mistake too. That early lesson reinforced the idea that holding good businesses for a long, long time is where the real magic happens. Compounding interest, as Albert Einstein supposedly said, is the eighth wonder of the world. It's like rolling a snowball down a very long hill. The longer it rolls, the bigger it gets. If you find a truly great business and hold it, letting the earnings reinvest and grow, their results can be astonishing. Our favorite holding period is forever. We didn't get rich by buying and selling stocks constantly. We got rich by buying wonderful businesses and letting them grow for decades. Our long-term investment in Geico is a perfect example. I first learned about Geico in 1951 when I was a student at Columbia University under Ben Graham. I actually took a train down to Washington, D.C. on a Saturday to visit their headquarters. I badgered the security guard until he found one of the top executives, Lorimer Davidson, who spent 4 hours explaining the business to me. I was captivated. It was a business that sold direct, cutting out agents, offering lower prices to better drivers. Classic example of a business with a distinct competitive advantage and a clear path to growth. I invested a good portion of my net worth in Geico back then. Now, what a bonehead I was. I sold my Geico stock for a nice profit, thinking I could redeploy the capital elsewhere. A few years later, I watched it soar, and I realized my mistake. But the lesson stuck with me. Later in the 1970s, Geico ran into trouble. They had some problems with their underwriting expanding too quickly. The stock plummeted. Charlie and I saw an opportunity. We knew it was still a great business at its core. With a powerful low-cost structure, we started buying, eventually taking control of the entire company. Today, Geico is a jewel in the Berkshire crown, consistently profitable and growing, a testament to the power of a simple, effective business model and patient ownership. This brings me to the importance of patience and temperament. Investing isn't about IQ. I've seen people with 160 IQs fail because they lack the right temperament. You need to be able to sit through market fluctuations, ignore the talking heads on TV, and stick to your knitting. What you want is emotional stability and rationality. You need to be able to think independently, not follow the herd. When everyone else is panicking, that's often when you find the best opportunities. As Ben Graham taught, be fearful when others are greedy and greedy when others are fearful. It sounds simple, but it's incredibly hard to do when the market is going wild. My dad taught me a similar lesson about integrity too. He always said it takes 20 years to build a reputation and 5 minutes to ruin it. That applies to businesses and to how you approach investing. Don't chase fads. Don't get greedy. Don't try to get rich quick. Just focus on understanding what you own, buying at a fair price, and letting time do its work. It's a marathon, not a sprint. And speaking of sprints, I still drive myself to the office every day in my Cadillac, bought a few years ago. No fancy chauffeurs for me. I still live in the house I bought in Omaha in 1958 for $31,500. I spend 5 to 6 hours a day reading. That's probably 80% of my day. I read annual reports, 10Ks, books, newspapers. I'm just looking for ideas, for bits of information that might tell me something about a business, its industry, its competitors. It's about continually learning and absorbing information. You don't need a Bloomberg terminal or super fast trading algorithms. You need a comfortable chair, a pile of annual reports, and a quiet place to think. That's how Charlie and I operate. We're not doing anything magical here in Omaha. We're just reading and thinking. Now, a lot of folks ask me about technology. They wonder why Berkshire didn't get into tech earlier or why I generally avoid it. It comes back to the circle of competence. I don't invest in businesses. I don't understand. For a long time, technology companies were outside my circle. I couldn't understand their competitive advantages or how quickly they could change. But with Apple, that was different. What I saw in Apple wasn't just a tech company, but a company with an incredible consumer product, a sticky ecosystem, and immense brand loyalty. People love their iPhones. They love the company. That to me looked a lot like a consumer brand with a very powerful moat. And their management, led by Tim Cook, is exceptional. So Charlie and I made an exception to our usual tech avoidance because it fit our understanding of a powerful brand. The key takeaway here is define your circle of competence and stick within it. It's not about how big your circle is, but how well you know its boundaries. You don't need to understand every business in the world. You just need to understand a few good ones really well. That's enough to do extraordinarily well over time. You don't need to do extraordinary things to get extraordinary results. Simple, sensible things done consistently over a very long time will get you there. A shareholder once asked me at our annual meeting, and we get 40,000 people showing up in Omaha these days, a truly amazing sight. They asked me, what's the best advice you've ever received? And I think back to that Ben Graham and his concept of the margin of safety. Price is what you pay. Value is what you get. The margin of safety is simply buying something for less than its intrinsic value. It gives you a cushion. So if things don't turn out exactly as planned, you still have some protection. It's the single most important concept in investing because it protects your capital. You have to figure out what the business is really worth and then buy it at a discount to that price. And how do you figure out what a business is really worth? You project its future earnings power, its cash flows. It's not rocket science, it's common sense. If you were buying a hamburger stand, you'd want to know how many hamburgers they sell, what they cost to make, what the rent is, what the competition is like. You try to estimate how much cash that business would generate for you over its lifetime. Stocks are just little pieces of businesses. It's really no different, just on a grander scale. The truth is, many investors make things far too complicated. They get caught up in market timing, trying to predict interest rates or what the Federal Reserve will do next. You can't predict those things consistently. Charlie and I never make a decision based on those kinds of predictions. We just focus on the value of the businesses we're buying. It's just like playing bridge with Bill Gates, my friend of many years. You focus on the cards you have and the probabilities, not on trying to guess what your opponent had for breakfast. What I tell my younger self, or any young person starting out today, is to start early and focus on building good habits. Spend less than you earn, invest the difference wisely in businesses you understand, and let compound interest work its magic. Avoid debt like the plague, especially credit card debt, which is like usury at its worst. I've never borrowed significant money to invest, and that's kept me out of a lot of trouble when the markets got rocky. Being financially conservative creates freedom. And speaking of freedom, it's not just about money. It's about designing a life that you love, surrounded by people you love. Charlie and I, we love what we do. We enjoy the intellectual challenge, the pursuit of understanding businesses, and we get to work with people we admire. That's a huge part of the secret to a long, happy life. I still love my cherry Coke, my C's peanut brittle, and a good McDonald's hamburger for breakfast. Simple pleasures. After 94 years of doing this and more than 60 years at the helm of Berkshire, here's what I know for certain. The principles of sound investing are timeless. They don't change with technology or market fads. The human nature aspects, fear and greed, they repeat themselves over and over again. A smart investor recognizes this and acts rationally when others are acting emotionally. I'm 94 now, and if I could tell young investors one thing, it's this: cultivate patience and discipline. Don't feel like you need to be doing something all the time. Sometimes the best thing you can do is sit quietly and do nothing. Wait for the fat pitch. Investing is like baseball. You don't have to swing at every pitch. You wait for the one that's right in your sweet spot, and then you swing for the fences. I'd never bet against America. This country has an incredible ability to overcome challenges. The future, despite its ups and downs, has always been bright for those who are patient and disciplined. You don't need to be brilliant. You don't need inside information. And you certainly don't need to listen to all the noise out there. Just buy good businesses at fair prices. Let them compound and ignore Mr. Market's mood swings. That's the simple truth of it all.